Okay, let's dive into this. Welcome to today's explainer, where we're going to unlock the mathematical secrets of the financial markets. If you've ever stared at a price chart and just wondered if there's some kind of hidden logic behind all that chaos, well, you're absolutely in the right place. Today, we're demystifying market movements by taking a really structured, analytical approach. We're going to build a mathematical toolkit today. Actually, scratch that. It's more like a mathematical blueprint. And don't worry, you won't need advanced calculus for this. Just some basic addition, subtraction, and a logical mindset so we can approximate what a market might do tomorrow based purely on exactly what it did today and yesterday.
So our guiding text for this whole journey is George Angell's Sniper Trading Workbook. And what makes this specific source a real game changer for us is that it's not just theoretical fluff. It's designed from the ground up as a hands-on step-by-step study guide. We're going to look really closely at the cut-and-dry formulas Angell lays out to help traders master some deeply complex trading logic. So grab a mental notepad because we are going to walk through these precise calculations together.
All right, here's our syllabus for this explainer. 1. Taylor's book method. 2. Measuring rallies and declines. 3. Projecting the target top. And 4. Constructing the buy envelope.
Section 1. Taylor's book method. Embracing market complexity. Before we start crunching the numbers, let's look at the overarching philosophy driving all of this.
Now, the formulas we're studying today actually originate from George Douglas Taylor. As George Angell notes right in Chapter 1 of his workbook, Taylor's contribution to technical analysis is just absolutely monumental. Taylor created something called the book method, and George Angell later adapted and expanded upon that foundation to create his own LSS 3-day cycle method. So we're really looking at the genesis of a truly powerful analytical framework here.
I really want you to listen to this quote from the workbook. Angell writes, "The market is complex and does not always offer an easy answer. The sooner you recognize this complexity and integrate it into your trading, the better off you will be." This is so crucial to keep in mind. These formulas, they aren't magic bullets that are going to predict the future with absolute certainty. No way. They are sophisticated tools designed to measure uncertainty and help you find logical probabilities within a deeply complex system.
So what exactly is this book method? Well, at its core, it's the practice of measuring both market rallies, the upward movements, and market declines, which are the downward drops. By measuring these two opposing forces, you average the numbers to arrive at a highly educated approximation of what should occur on the very next trading day. It's basically about letting the market's recent history dictate its immediate future.
Section 2. Measuring rallies and declines. The first building blocks. Okay, let's get into the actual math now and focus on our first two critical variables. First up, we have the rally number. This specifically measures upward momentum across a 2-day period. It tells us exactly how far the market was able to rally from one day to the next. And the formula is incredibly straightforward. You simply take today's high, meaning the high of the last completed trading day, and you subtract the previous day's low. Simple, right? Let's visualize this using the exact S&P 500 example that Angell provides in his workbook. Let's say the last completed day's high, today's high, is 1274.00. We look back to the previous day and find that the low was 1231.00. Our calculation is just, subtracting that previous low right from today's high. Boom! That gives us a rally number of exactly 43 points. Now, how do we actually use this in practice? Well, if we want to estimate how far the market might rally tomorrow, we take tomorrow's low, once it's firmly established, of course, and we add this 43-point rally number to it. It provides us with a mathematically sound approximation of where the next high might end up. But as we all know, the market doesn't only go up. We need our countermetric, which is the decline number. This one tells us how far the market typically falls. To find it, we measure the difference between a prior day's high and today's low. This captures the average downward movement over that exact same 2-day window. Let's look at another quick workbook example to lock this in. If yesterday's high was 1294.00 and today's low dropped down to 1286.00, we run our subtraction. We just take the high minus the low, which leaves us with a decline number of 8 points. Now, what's really interesting about this slide is how it looks ahead. Let's say the market rallies tomorrow and sets a brand new high. We can actually subtract this 8-point average decline from that new high to predict exactly where tomorrow's low might logically find support. So to quickly recap our first two building blocks side by side, the rally number measures the upward reach stemming from a previous low, while the decline number measures the downward drop falling from a previous high. It's like breathing. You're capturing the extreme swings to find the market's natural rhythm, in and out. Moving on to Section 3, projecting the target top, the buying high number. This next critical building block focuses purely on the strength of a rising market. We call this the buying high number. It measures exactly how far above the prior day's high the market managed to trade today. The formula is simply today's high minus yesterday's high. Now, what's really unique here is that in a strongly rising market, you're going to get positive numbers. But in a declining market where the tops are getting lower and lower, this formula will yield negative numbers, which acts as a massive signal of weakness.
Let's break down the math using Angell's precise S&P numbers again. Say today's high is 1249.00. Yesterday's high was 1243.00. We subtract yesterday's high from today's, which gives us a positive buying high number of 6 points. So the crucial point is, what happens when we use that number to project into the future? If we assume the market is going to maintain this exact same momentum tomorrow, we just take today's high of 124.90.00 and add our buying high of 6 points. That gives us a projected target top for tomorrow of exactly 125.00. It is a completely calculated, emotionless way to set your expectations for a rising market.
Finally, Section 4, constructing the buy envelope, synthesizing the formula. We've got all our individual building blocks, so now it's time for the grand finale. The buy envelope is basically a zone made up of 4 distinct puzzle pieces. First, you take the average of the last 3 decline numbers and subtract it from the last high. Second, we do the inverse, the average of the last 3 buying under numbers subtracted from the last low. Third, we just drop in the raw value of the last low itself. And fourth, we cap it all off with Angell's proprietary trend reaction buy number. And this brilliantly illustrates how, by layering these 4 specific data points together, a trader builds a structured envelope of support. It's an area where the math itself suggests a bounce is highly probable.
Which brings us right back to where we started today. As the workbook warns us right out of the gate, the market is complex and it will literally never offer you an easy answer. But you know what? You're no longer operating in the dark. You now have the nuts and bolts to measure rallies, measure declines, target the tops, and build these structural envelopes of support. So the question I leave you with is this. Now that you have these tools, how will you integrate this mathematical complexity into your own trading strategy? Think about how understanding the exact rhythm of yesterday can help you master the movements of tomorrow. Thank you so much for joining me on this explainer, and I really hope this changes the way you look at the numbers out there. Catch you next time.